Hello and welcome to this webinar. Good evening in India, good morning in US. I am Nilesh Munda from ICICI Bank Private Banking and Wealth. I look after investments for our private clients. With me today, I have my colleagues Samir Narang and Pankaj Pandey. Samir is a very senior economist and a very, has more than 2 decades of experience in the industry. Pankaj heads research, equity research in ICICI Direct and has been with ICICI Group for more than 20 years, like myself. In this volatile world and uncertain world, we thought today we will discuss what's happening in India, the near term risks, the global setup, medium to long term opportunities as we go about. I'll begin with Samir, first of all. till September end, it looked like that, Indian market is the only market globally, and it was defying all markets. Indian economy was doing quite well. And since then, we have had a sharp reversal in foreign flows, such that we have not seen this kind of outflows for a long period of time. What do you think has been the reason? Is it more of a tactical adjustment that has happened, or some kind of durable shift?
Well, first of all, thank you, Nilesh, and a very warm welcome to all the participants who've taken our time today. Thank you so much for taking our time. I appreciate the same. On your question, Nilesh, well, the outflows that have happened were triggered by a number of factors. Some were centric to India, some were global in nature. In terms of factors which were global in nature, prior to the outflows that started in India, we had a stimulus that came in China. And it was assumed that the Chinese economy, which was gradually decelerating, would get a kickstart or a jump start, which will draw inflows into that market. Valuations, they were breathtakingly cheap, and but so was growth. Growth was also very low. Earning downgrades were visible over the last few years, and earnings have not caught up over the last couple of years, actually. So this was thought to be one of the factors which would drive growth over there, and it led to a lot of retail participation in the stock market as well as FPI money pouring into the country. Uh, as a matter of fact, we saw outflows from a number of EMs and money flowing into China. The trade had changed that point in time. But in between, during around about that time, we also, Nilesh, had the rising odds of President Trump likely to be sworn in America. The US betting markets, any which ways, were putting the odds at around about 60-65%, which gradually continue to go up every week. And what we had was during that time, US yields going up, US markets looking more attractive because a corporate tax cut perhaps over the course of the next 12 to 18 months is on the anvil, and a lot of money started flowing into the US fixed income and equity markets. So you had broader money flowing out of all EMs, not only India, during that phase or point of time, including China. Even the bond market, you were seeing outflows, and so was the case in equity markets. On top of that, and that's not the end of the story, we also had domestic cyclical issues. Number one, there was an unanticipated drawdown in the earnings trajectory for the Indian companies. What we saw was that a large number of Indian companies that reported results, there was a meaningful correction in their earnings trajectory, and the market started repricing much lower earnings for the year. And add to that, there were instances of corporate companies reporting a slowdown in earnings, slowdown in consumption, particularly urban rather than rural. And all of those factors, when you have valuations which are slightly on the higher side, combine to make a case for a correction in the Indian equity markets. Now, to your point that uh, is this a tactical worry, short term over the long term? So I think we need to dissect this, a cyclical slowdown versus a structural underlying factors or strengths of the country. What has happened materially, as you are aware, the Q2 GDP also got reported, yesterday, and we saw GDP growth was also at a two-year low, and that was essentially driven by weaker consumption, weaker investment. Government spending in the year has been fairly weak. That is because of elections, and after that, just capex by the government has not caught up to the extent we've been seeing over the last 4 years. Post-pandemic, Indian government led by the center has doubled its capex as a share of GDP, but this year capex is actually down by 15%. So that is one of the factors, which is a tactical slowdown, which is driving the numbers lower. The other is that the Q1, apart from elections, you had unexceptionally very high heat. And in August and September in this year, you had rainfall which is around about 8 and 12% higher than usual. So overall, what you have seen is exceptionally high rainfall in Q2, exceptionally high heat in Q1. All of that put together has had a an impact on consumption. But apart from that, there have been other reasons also why a cyclical slowdown was on the annual. One of that is that wage growth in India has moderated. Wages in India or overall wage increments, including new hires for Indian companies, were running at around about 11 to 12%. That has come down to half that run rate of 6 to 7%. So it is but expected that there will be a tactical slowdown. Even credit offtake has come down from where it was. We were running at a credit offtake led by unsecured and personal loans around about 15 to 16%. That's come down to around about 11%. So there were a number of indicators, and we can talk about so many high frequency indicators which were telling us that there is a cyclical slowdown which is on the anvil. But I think what caught people by a little bit of surprise was the corporate commentary, which reported very sharp slowdown in offtake. However, that's not all. That's how it is played out, because in October we had a fairly good festival season. In 42 days, a festival season that is there in India, which ends during the Diwali and starts prior to that. Uh, the overall uh, two-wheeler sales were in double digits. Even passenger vehicle sales grew at 7% volume. So it's not that the slowdown is going to persist or it's a very deep structural slowdown. It's a cyclical slowdown because of a number of variety of factors, and it's going to even itself out. The other thing which has moved in India over the last couple of quarters is food inflation. That's been very, very high. It's right now running at double digits. And as I explained, first you had very high heat in Q1, and then you had very excessive rainfall in Q2. So, and both of these things have an impact in terms of perishable items, and they cannot be stored to that extent. And prices went up, and as food inflation inched into double digits, consumers withdrew from other discretionary items. Now, can food inflation continue in double digits? Well, I don't think so. If you see in the month of November itself, the month on month vegetable prices are down by 7%. So India always is a story which is moving every month. And what we are seeing is that after the tactical slowdown or cyclical slowdown, a number of these factors are also converging towards the mean. The other thing which has also contributed to the tactical slowdown is lower FPI inflows or outflows, and net FDI inflows not picking up, because of which the BOP surplus that we used to get every year is much lower this year, and that itself has an impact on liquidity in the system, because as RBI provides dollars to the market, the rupee liquidity actually dries up, which is the case right now. And the government has also spent its ammunition in terms of excess cash balances. So all of that put together has also added to its own level of pressure for the slowdown in the economy. But remember that India is one of the countries which has given the least amount of monetary and fiscal stimulus over the last few years. So we have dry powder or policy headroom. And I believe going forward, you should see the RBI at least stepping up with this policy dry powder or headroom, which it has available to itself from the December policy itself. And we'll talk about it a little bit later in detail.
Sure. It's ironical that, our own expectation of Indian growth is so high that from 7.5%, if it slows to 6%, we call it a slowdown. While in global context, 6% itself is too huge. Anyways, thank you for that. Pankaj, as Samir alluded to that, we have had a confluence of factors and maybe they all kind of lumped up together in September, October, and October, November. What is your sense on the same, and how do you see is the situation panning out today? And maybe to kind of make things difficult for you, one of the questions that I have from one of our participants, few of our participants rather, is the correction in Indian markets over? So I would like you to kind of respond to both of them.
Sure. So before that, good morning all. A warm welcome to this webinar. Now, I'll start with the last question first. So when you look at historically, say a large cap index like Nifty 50, so every year it has a tendency to correct by 10 to 12 or 10 to 15 odd percent for every year, and it could happen multiple times in a year. And for various rhymes and reason, similarly, the mid cap index has the tendency to correct even more higher at 15 to 20 odd percent, and the small cap can correct 20 to 30 odd percent. While the individual stock level correction could be a lot more higher, but at the index level, you could easily get corrections of these kinds. And these are pretty normal kind of a correction. Although you get higher corrections also, but that happens in unusual cases like, say, for example, when we had COVID, the Nifty or the large cap index had corrected by 38 odd percent. So, or when you had this 2008 financial impact on certain sectors. Now, I'll come to the earnings first. So when you look at the overall setup of earnings for this year and next year, so broader expectation is about 12% kind of earning growth for Nifty companies, which is large cap, by about 12 odd percent, and followed by about 15-16% kind of a growth a year after. In this particular quarter, earnings were definitely muted, or so when you look at the top line has grown by 6%, the bottom line has grown by about 3 odd percent. But I think this overall slowdown in earnings or weaker set of earnings is largely because of the commodity-led slowdown what we are seeing. So globally, two commodities have been impacted. So one is crude oil and the other one is steel. And because the demand for crude oil has been weak, the gross refining margins for oil marketing companies or oil refineries have been weak. So last year, gross refining margins were somewhere about $15-16 per barrel, which had come down to about
Okay, I guess.
any credit.
Okay.
One, GRMs have been substantially down compared to last year. The other factor is that since China is really not doing well, they are dumping a lot of commodities, especially a commodity like steel. So, which is why the Indian steel prices are at a 3-year low, and it had its own share of impact. And so, from a Nifty earnings perspective, 30% of your earnings is coming from oil and gas, and this sector or this segment had seen a profit decline of nearly 27 odd percent in this particular quarter or last quarter, which went by. And that has been the biggest reason. If you strip out that number, the bottom line growth is 10 odd percent, which again is a very respectable number. Now, the other aspect to this also is that we had a sector like, say, cement, which got impacted. Now, understand this, we had an election year and the budget got passed somewhere mid-August. And after that, you had a monsoon, which was quite extended. So somewhere down the line for a local commodity like, say, cement, 60% of the cement demand comes from housing, which was okay, and 30-35% comes from infra spends. I think infra spends is something which was weaker, one, because budget got passed late, and then subsequent to that, we had this extended monsoon. So when your 1/3 of the demand is really not up to the mark, obviously it has its own impact in terms of the overall earnings, and which is why cement prices in India are at a 1-year low. So this current set of weak earnings is a confluence of one, weaker commodities, both local and global, and largely attributed to the slowdown which is there in the China. Now, overall sense is that in the second half, earnings are going to be a lot more better. So every year, whatever the government announces in terms of budget, so capital expenditure last year was 10 lakh crore. This year is about 11 lakh crore. They are expected to achieve 95% of those numbers. So while in H1 of this year, overall achievement was weaker, but our sense is it is going to sort of be a lot more better in the second half. Now, on the inflation bit, I think the 6.2% kind of a reading what we got on the inflation, our senses is largely because of the three commodities, especially the onion, potato, and tomatoes. And if you sort of strip that out, what you are getting is a 4% kind of an inflation, or below 4% kind of inflation, which is what the targeted range by RBI. On the FI selling, yes, FIs have been selling, and largely because, like Samir highlighted, uh, the overall market in the US were tilting toward the Trump win, and from that perspective, there was an expectation that when Trump comes in, he's going to cut rates, especially the corporate tax rates, and which means that the US equities are looking a lot more brighter, and which has been the case up till now. The US equity markets have done well, and which is why the money has been moving out of India. And overall, what we see is a decent amount of correction in the market. Now, when you look at the inflow outflows, so FIs have sold about $14 billion kind of in equities, and which is why in the near term or in the shorter term, the US markets are definitely doing better and looking attractive on the back of anticipated rate cuts, corporate tax cuts. Then I think there are other factors also in terms of US elections. So US elections are in general is liquidity negative for India, but it is definitely positive for some of the pockets. So for example, it could be defense, it could be a sector like pharma. Discretionary spending is expected to go up. So overall, our sense is that with this kind of a correction, what we have seen in the market of 12 odd percent, most of a bulk of the correction is behind us, and we are closer to our bottom, because this kind of a correction is pretty much normal. And even if the capital expenditure does not pick up overall, our sense is that the miss on the earnings or the downward revision in the earnings is going to be in the range of 4 to 5 odd percent. And so from that perspective, it's not going to be a
Okay.
material downgrade. So from that perspective, I think worst is behind us in terms of the kind of weakness in the market performance what we have seen. We are expecting second half to be a lot better.
Okay, great. Thanks, Pankaj. So I think both of you concur that, it was one off. We do get these kind of cyclical adjustments from time to time. 10-12% kind of market fall is par for the course. And going forward, obviously, things look much better. So, Samir, beyond the here and now, the FI outflows, etc., the last 6 months of history that we've kind of spoken about. Going forward, while like you also articulated and Pankaj also said that things look better as far as India is concerned, but then there is a new thing, which is as Mr. Trump kind of gets sworn in, he is said that he is going to impose tariffs, 10% to 60% all the way on China and pretty much everywhere. In the base case scenario where some tariffs are actually imposed, how do you see it's going to impact India, positively, negatively, and more especially towards Indian rupee, in context of the fact that if, let's say, Chinese yuan were to depreciate in response to tariffs, then can the Indian currency also weaken, and how much so?
Well, Nilesh, you've put it very aptly. Very rarely do you see a situation in which, even before the incumbent president has been sworn in, he announces on social media that he's going to impose tariffs unless and until certain steps are corrective recourse or action is being taken, and where he left off in terms of that action a couple of years back. So very rare, you're right, and that already has had an impact on markets, as has been already discussed, with the fact that yields have been going up in the US, thinking that there will be higher tariffs, there would be a reduction in taxes, both corporate taxes as well as continuation of the earlier tax reductions that were done in 2017. US fiscal deficit is anyways running at 6%, northwards of 6%, and it's anticipated to go up even more. Apart from that, the policy agenda also includes anti-immigration and deregulation. All of these will have a very deep impact on global economic structures as well as markets. Now, let us go into it, starting with for instance, the tariff plan, which the president has been saying. He's saying that he will put additional tariffs of 10% to begin with on China on 20th of January and 25% on any imports from Canada and Mexico. Notably, Nilesh, these three countries put together, along with Europe, contribute 70% of US imports as well as 70% of US trade deficit. If you add Vietnam to it, it's 80%. So these five geographies put together constitute 80% of US goods trade deficit. US runs a surplus and services account. So to that extent, given that India is a net services exporter and a net goods importer, though India does have a trade surplus with the US in the goods account, but we rank somewhere seventh or eighth in the pecking order in terms of countries which have much higher surplus. So what one can say is that some of these countries will have a heightened impact. In case of Trump 1.0, when he announced tariffs from China, the Chinese yuan depreciated. Mexico, with which he ultimately cut a deal in terms of free trade agreement, the currency was down by 20% even then. And this year, to begin with, already the dollar is strengthened by approximately 5 to 6%, depending on which point you take it at. And the Canadian dollar, the Mexican peso, everything is falling. The only currency which has done exceptionally well is the INR and the Chinese yuan, which is only depreciated by 2%. Can there be further depreciation in the yuan, as you're saying? Yes, there can be, because if the tariffs are raised, a part of it will be adjusted through currency, a part of it will be adjusted through price hikes within the US. So some part of it, as you can see, if the tariffs, he's also proposing a unified tariff of 10% on all imports. So if the dollar has already appreciated by 5% or 6%, half the pain has already been taken away. So prices only need to go up by half of that amount. And ultimately, there will be deals that will be struck. So you may not have that much of an impact. But the one thing is increasingly becoming clear, Nilesh, as you pointed out, that the tariffs on China, either which ways, will go up. Whether they go up on other geographies or not, we don't know. And this will have a reverberating impact on Asian economies, because China competes with most Asian economies on one or the other product segment, be it textiles, be it electronics, be it semiconductors, be it furniture, be it other, iPhone manufacturing, in which India has a 10% market share in iPhone global exports now. So you will see, Chinese currency competing with all the other Asian currencies. The Chinese also have a tremendous amount of excess capacity, which they are offloading into the world economy. And if US is not available, that will be offloaded to other ASEAN countries and Latin America. Notably, Chinese export, the share of US in Chinese exports has come down from approximately 19% to 14 to 15%. But the share of LATAM and ASEAN have actually gone up by 4 to 6 percentage points. So whatever drawdown is happening in case of US, China is actually sending more products to ASEAN countries and to Latin America and to countries like India. So what is likely to happen is that other currencies will also weaken. That goes without saying. But at the same time, the fiscal expansion that you are seeing in the case of US with the tax cut will also imply more money in the hands of US consumer and US corporations. Now, whenever US corporations have a slight bit of more cash flow with them, they tend to spend a lot more of that on digital implementation and digital products and services. And India benefits a lot from that because India has a large IT services exports and GCCs. So at the end of the day, that money, a part of it will flow into India in terms of higher job creation in the Indian IT services market. As Pankaj pointed out, this would lead to some kind of rebalancing in terms of earnings as well, and optimism. The second would be that if India is spared from these tariffs to begin with, and there are more tariffs on China, India is any which way is competing with China in a number of categories after the production linked incentives have been launched. So you should see higher exports any which ways coming out of India once the US consumer is spending a lot more after these tax cuts and corporate tax cuts and income tax rebates or reduction. So all of that put together, I would say things from a economic or a trade standpoint are not that bad for India. But yes, the Trump the way the economic policy making will play out, because fiscal deficits will be higher. The Fed will have lesser room to cut. We anticipate maybe 4 rate cuts or 3 rate cuts between now and the next year. So what that means is that global rates have to remain higher. More money flows into America. That implies lower inflows into EM. So lower ability of central bank to cut rates, or more intervention in the FX market, lower liquidity. So all of that will have a role to play in terms of the growth paradigm. So I think India will not be impacted so much on the trade front as much as on the capital account front. But the other policies, particularly the anti-immigration and the deregulation that you may see from an American standpoint, may also lead to much higher growth in the US markets and world markets, because more amount of M&A may happen. And if anti-immigration drive also leads to lower amount of visas being issued, not only for the undocumented, but for the skilled workforce as well, that implies more offshoring generally that should happen into India. So at the end of the day, I would say from an economic standpoint, things are, basically you'll gain some, you'll lose some. But the biggest impact, Nilesh, you're right, will be felt via through the a weaker Chinese yuan, which it would, like last time when it had depreciated by 5 to 6%. And that will have an impact on all Asian countries, including India. But on a relative basis, the currency stands where it began with, because all currencies in Asia will beyond a point depreciate. So there will be no relative competitive advantage. But yes, on an absolute number, you would see that currency has weakened.
Yeah, but what you're saying is that, since dollar is appreciating, dollar has appreciated, while all currencies are going to see an impact. In an Indian context, it will get impacted the least, and on a relative basis, it might actually appreciate versus other currencies which are bigger trading partners to US. Yeah,
absolutely correct.
Okay. Pankaj, so like you indicated, maybe part of this correction. Like Samir is also saying that a lot of what is going to happen in terms of tariffs through the currency route is discounted, and some bit more will come. But naturally, we have seen a correction, therefore, and some more may happen. Maybe in December. So somebody if has to take, and since we're talking to non-resident Indians and all the way in US, for example, North America, for example, and if they have to look for something, 5 to 10 years, what are the areas of opportunities that you see from a 2-3 year perspective, 7-8 year perspective as well? Also considering the fact that, will these tariffs over the next 2-3 years or so in China, will they drive some business? What we keep hearing, China plus one, for example, will it drive business to India? So what are the opportunities for an investor, and what are the areas you would avoid?
So Nilesh, so before I come to individual sectors, see overall, when you look at the construct of Indian GDP, so overall sense is that we could be growing at 6 to 7 odd percent with an inflation of 4 to 5%. That means the nominal GDP is going to grow at 11 to 12 odd percent. And typically, the best of the companies, which is represented by a large cap index like Nifty, is expected to deliver 12 to 15% kind of earning growth. So we could be easily doubling our earnings in the next 5 years. So Indian equity is one of the few segments which is offering a double-digit kind of a returns. Now, within that, there's some themes which are playing out quite strongly. So one of them is the capital expenditure. Now, last 5 years, we have seen capital expenditure growing at 20% CAGR, and we believe that it has got structural legs to it. So here, the entire capital goods as a space, infrastructure, and cement look particularly attractive to us. I can't really say the same thing about steel, given the fact that it's a global commodity. We all know that China is not really experiencing the best of the growth rates, and which is why a lot of dumping is going on. And like I highlighted earlier, also the Indian steel prices are at a 3-year low. So despite the fact that the companies are have doubled their capex or capital expenditure in the steel side, I think they need some kind of a protection. So they're doing well depends on that, but I think the rest of the segment looks quite structurally positive. Then there are some regulations which are benefiting sectors like, say, banking and financial services. I think post insolvency and bankruptcy code, the borrower behavior has definitely changed. Promoters don't want to lose control of their company, so overall asset quality for banks has been in a pretty good shape. Real estate as a sector is doing very well, given the fact that now gone are the days when you had promoters launching multiple projects and not delivering. Now you have post RERA, what we see is a lot more discipline. And this industry is shifting from, say, unorganized to organized. And these are the other sectors which look structurally positive. And I think there's some energy transition theme which is going on globally. It's not something unique to India. So one obviously is power. The entire value chain looks quite good, especially the transmission and distribution side. I think not only India, but a lot of global economies are underinvested in that segment. We all know that going forward, we are going to derive more power from the renewable energy, and which is why power as a theme looks quite attractive. And auto is another sector which is seeing a transition. Various countries are at various stages of penetration, but India is also experiencing a pretty good transition, energy transition, especially from auto perspective, with the kind of launches what we are seeing. And so these are the structural beneficiaries. But if I have to sort of look at from say 2 or 3 year perspective, then I think what also needs to be figured in mind the kind of impact the US elections would have. So I already spoke about that it is a bit negative for from a liquidity perspective. But I think it could have a positive rub-off on some sectors, especially the likes of, say, information technology, because if US goes for a corporate tax cut, what it could mean is that potentially the overall discretionary spending can sort of go up, which is positive for Indian IT companies. Now, while there is a risk in terms of higher onshoring, which could have margin implications, but net, it is expected to be positive for IT companies. IT companies in general are expected to deliver high single digit kind of a growth rate this year, and possibly lower double digit kind of a growth rate in FY26. Defense is another segment which can benefit because a lot of cooperation between India and US is possible. We require a lot of technology in terms of, say, for example, emails kind of a technology for future aircraft carrier, or engine technology for a lot of fourth and a half or fifth generation. On the pharma side, what we are clearly liking is the fact that the Biosecure Act is going to become legislation. And what it does is that it prevents Chinese companies or CDMO players from accessing US funding, and also collaborating with the US-based companies. And so, which is why China plus one in this segment is expected to pan out in a big way. And I think there is a wider fear that these Chinese CRAMS companies might sort of steal the IP, or possibly tinker with the US genetic codes, and which is why this kind of a legislation is extremely positive for a country like India. In addition to that, since the tariffs are going to be higher for a lot of products coming from other geographies, and lesser for India. So our sense is that you will have pockets, say, for example, auto, engineering, textile, which could benefit from the tariff arbitrage. So these are the sectors which are looking good for the next 2 or 3 years. And structurally, I already highlighted sectors which are looking good from a 5 to 10 year perspective.
Okay, so both of you have been talking about the fact that, clearly whatever is happening is good for US. It's not good for the world, and India is going to be relatively net beneficiary, but mild impact here or there, some opportunities, some threats. Now, one of the questions that come up in this context, both Samir and Pankaj, is that somebody who is in North America or who is an NRI, therefore can allocate globally. Why not allocate 100% of his or her savings to US? Why look at India at all? or for that matter, I mean, one can always look at emerging markets, but in that, why look at India at all? Now, just one fact while you think through and kind of, choose to respond, one of the things that we always see is that India commands 3% of global market cap or equity allocation, while US is 60 to 63%. The GDP share is more like 3-4%, and US may be like 25-30%. So, wouldn't one be better off having 100% in US and nothing in India? I think that, maybe 10-20% should be in India because of Pankaj, what you said, and what Samir said, that, we have longevity of growth across variety of sectors, and US probably is more concentrated. So, what is your sense? How much should one allocate to India, given the long-term opportunity? And
So I
both of you
think
can respond. Yeah.
yeah. No, I think very interesting question, Nilesh, the way you put it. So I think there are various ways to, look at this. So there is a geographical aspect to which you covered in terms of what would the best allocation be, and then there are asset classes within that, whether one should go into real estate, into bonds, or into equities. Now, if you do see historically, in case of India, at least, what we have seen is that inflation-adjusted real returns, adjusted for dollar, would actually perhaps match over the long-term period, say of the last 20-25 years. It will be very, very equal compared to what you've seen in a market like America. But there have been tectonic shifts within the American market as such, where the share of technology actually has been going up in the index, and some of these technology companies have done fabulously well over the last decade or so in terms of global reach. And even today, we see so many companies benefiting from selling their products across the world. So, but in India's case, most of the companies which are listed perhaps would, apart from IT firms, the share of exports would be on the lower side. So there are manufacturing firms which are doing that, and services companies like banks are mostly focused on the domestic economy. But I would say that, given as Pankaj also pointed out about the fact that the normal GDP growth is expected to be close to double digits, and earnings perhaps will be in line with that. And if you see currency depreciation, which ideally is expected at 1 to 1.5% over the course of the next couple of years, you are likely to see a dollar-adjusted return, which is fairly good. So that makes India as attractive as a market that you would see in any other part of the world. Valuations have also corrected to a large extent. But if you do see from a bond market perspective, things have changed a lot. US bond markets have become, or US bonds or yields have become far more competitive and attractive than they were a decade back, after the global financial crisis, when the Federal Reserve actually kept rates for the longest period at the lowest minimum level possible because inflation was not a threat. However, on a real adjusted basis, returns were very low over the last decade or so, and post-pandemic, now as we speak, inflation in the US has settled around 2.5-3%, and yields are somewhere around 4.25. So you are seeing 1.75 to 2% or thereabouts of real rates in case of America, which is fairly unique and rare. And in case of India, the dollar-adjusted return, we are looking at a 10-year yield of closer to 6.6, 6.5, 6.6 in around about March, by when we'll have more clarity on what the RBI is likely to do. We feel perhaps liquidity infusion in December and a rate cut perhaps in February, given the inflation print was very high in the last reading above the tolerance band. So that does lead to some more decline in yields in the longer end. Shorter end, of course, will be far better placed because of availability of liquidity, as well as rates are cut, that would move in line with the RBI rates. But overall, what you are likely to see is a fact that Indian yields adjusted for for currency depreciation will be fairly competitive and will give you fairly good returns compared to US, where you should expect inflation-adjusted returns of closer to two and a half, to at best 2%, because we do expect the Federal Reserve to cut rates by perhaps 100 basis points, so that will have an impact on the yields. But you should see a steepening bias, in US yields as well, because fiscal deficits are likely to be very high, supply is likely to be elevated. And in India's case, the government is looking at fiscal consolidation. So what you are looking at is a very attractive play for India in terms of bond markets. India has been included in the global bond indices after a very long time. More inflows are likely to happen in the coming few years as well. So what we are looking at is a fact that the Indian, not only the equity market, even the bond market is actually very, very well placed as we speak. But the impending, tax cuts, which Pankaj also spoke about, does make US equity markets fairly attractive, particularly the technology play. There is very, very attractive for some of the large companies. But we should reckon that India also will benefit from cheap commodity prices as dollar strengthens, as global growth weakens led by China. You should see energy prices and other commodity prices actually coming off. And India is a net importer of energy and a few other commodity products. So the margins of Indian companies who are consumer facing will go up. That is a big positive for the Indian economy and Indian firms. The second part would be the shift in global supply chains, which we already talked about. IT will also benefit. So I think from a broader construct, after the tactical correction that we've seen, Indian equities also look fairly attractive. Now, coming finally to how the dollar versus INR play will play out. My sense is that we've already discussed how the yuan will react, but on an overall basis, even as the dollar strengthens even more in the interim, over the longer run, it will actually give up some of the gains, as we have seen during the Trump 1.0 tariffs as well, where it strengthened and finally it came down a little bit. That is also because over time, the other economies will adjust, supply chains move, and then eventually in the span of another 12 to 18 months, or maybe 18 to 24 months, there is some mean reversion that happens in the markets. So what you would see is eventually that there will be a rotation of funds into EMs back after maybe 18 to 24 months, and you are best positioned in the interim to identify the right countries and right asset allocation. So having said that, I think I do agree with you that allocation into EMs like India from a global standpoint make a lot of sense, and we should not forget the biggest beast over there is real estate, and India is looking at a very long structural upturn in its real estate cycle after a very long time. And that is perhaps likely to continue as urbanization picks up pace. We are one of the least urbanized countries in the world, and you are likely to see far more urbanization, and government and the state governments are spending a lot of money on infrastructure. Even in Mumbai, when you see the amount of metro, highways, the amount of roads that are being dug up, buildings that are coming up, that clearly tells you that there's a lot of underlying activity that is going on, and that will create a lot of demand for real estate as well. And on top of that, you'll have a variety of sectors which will be powering growth in the country, be it energy, be it renewables, where we continue to see a lot of investments, PLIs, manufacturing, contract manufacturing. All of that put together, makes India a difficult market to understand, but also very, very attractive and a long-term play, which is something that but one should keep in mind. And history, as in terms of returns, is on India's side, both on the bond side now and on the equity side. That's been the case for the long term.
Pankaj, quick 2-minute perspective.
So I think, reason why we believe the India's growth story is the strongest ever we have seen is because of a couple of things. One, I think you look at the demographics, we would have a fairly young population below 30 years of age. Even a few years down the line, unlike a lot of other global peers who are sort of experiencing a population decline. The other aspect is that macro stability is there. We have seen inflation being in a targeted range of RBI for quite some time. and which is why the Indian growth looks quite durable for the next 5-10 years. And also, when you look at a key data like corporate and household debt, so which is called as private debt to GDP, I think India is at about 50 odd percent compared to a global average of somewhere about 145%. What this typically means is that the Indian households and corporates have the balance sheet to support the consumption side of the economy and also the capital expenditure side of the economy. And I think the other aspect is that on the decarbonization theme, since we have really not built up huge capacities of, say, cement and steel, which is what China has done or some of the other overall economies have done. So, which means that we are really not sitting on a huge legacy capacity. So, it's easier for us to sort of shift. And same goes for the auto as well. And I think on top of it, we already have done or undertaken some reforms. So taxes, if you look at corporate taxes, are one of the lowest for manufacturing firms. I think digitization is a fairly big theme. The kind of welfare scheme this government is running, and the kind of benefit which is being passed on to the to a good number of population, or the quantum itself is fairly high. And I already spoke about, say, IBC and RERA. These are structural reforms helping crucial sectors like banking and real estate. Because real estate, if it does well, has a multiplier effect. So from that perspective, these are the other this thing. And as a result of this, what you see is a very healthy GDP growth rate. Corporate earnings have been one of the best in the last few years. On top of it, there's a focus on manufacturing, and we are seeing good amount of premiumization, especially in the kind of auto or, for example, in products like, say, hotels, hospitals. So we see a fairly premiumization trend there. So all in all, I think India's story is the strongest ever we are seeing up till now. So I think which is why Indian markets look the best.
Okay, great. I think that brings me to the end of our conversation, and a quick summary as I see is that we have a long runway for growth. US, and after US, as I see what you're saying, both of you are the concluding is that after US, if there's one market that one has to be allocated into is India. Currency is likely to be relatively better than many other emerging markets for that matter. Growth opportunity is going to be much better, and even the Trump related policies will impact the least and probably maybe growth accretive. And this correction, any which is provides a entry opportunity. Samir, you also alluded to the fact that interest rates at some point in time may kind of go down, and to that extent there may be an opportunity for customers to lock in yields through fixed deposits, NRE, FDs, FCNR, etc., and so on and so forth. Before we kind of come to a close, I have a few minutes, and we can take one or two more questions quickly. Samir, what's your view on gold prices?
So thank God you didn't ask about cryptos. So I think in terms of gold prices, we've seen a fantastic run, Nilesh, over the last couple of years. It started, with the Fed cutting, rates initially by the pandemic, and then you had the Russia-Ukraine war. Then the Fed started raising rates, gold prices, started coming off. And now again, the stock prices started going up as the Fed was on an easing cycle. But things have changed over the last 4 weeks to 6 weeks, as we've been discussing in this conversation over the last 50 odd minutes. And what does it mean for gold prices? Can they go up from here as well? So I think, yes, a little bit of, Fed easing cycle is positive for gold prices, but not to the extent we were thinking earlier. Some appreciation bias is likely to be there, but not a very material one from here, because the Fed cycle or the expected cut in interest rates is much lower than what we had thought earlier. That is one. But on the demand supply side, if you look, there is a reasonable amount of demand for gold that is coming from central banks and from consumers. Now, why from central banks? Because they've been diversifying away from US dollar or any other currency as a reserve in their FX reserves. A large amount is being plowed into the gold, which doesn't fundamentally have to rely on any other asset for it to have derive its own value. Unlike bonds or unlike the currencies which rely on other, be it fiat money, which relies on government bonds as the underlying security, or government bonds which rely on the fiscal outlook for their trajectory. So from that perspective, that diversification does create its own demand, which is positive. And I think whenever you have a period, Nilesh, when there is uncertainty in global markets driven by tariff war or currencies, consumers do also prefer to buy such an asset, because they do expect in local currency prices may actually go up as the currency depreciates. So what may likely to happen is that, and consumers do chase asset prices. So as asset prices in local currencies go up, consumers would tend to buy that asset, more of that. So I think there is an intrinsic demand, supply, and structural, some of these structural factors which favor prices going up somewhat from here, but not significantly high because of the Fed outlook.
So basically, what you're saying, keep your allocation intact, don't sell it, but don't buy big time, remain invested and add marginally as a hedge and maybe some upside. Okay. Pankaj, I think there's a question around FII flow dependency for growth in Indian equities. And we have seen a bit of outflows, and that has had an impact. So, what's our views? What is your view on that?
So yes, see, FI flows have been very important for Indian markets historically, because if things would have changed, then possibly with the $14 billion kind of outflow what we have seen in the last 2 months, Indian markets probably would have been down or should have been down by 20-30 odd percent, if not more. I think what has changed in the India in the last few years is that there is a growing realization within investors that India is the only market which can offer double-digit kind of a return. So it is becoming quite serious from a wealth creation perspective, or the investors are getting quite serious from a wealth creation perspective. And which is why, if you look at the kind of domestic inflows, I think those have been sort of topping the charts. So even when the FIs have been sort of selling heavily, in the month of October itself, we have seen inflows of nearly about $5 billion. What you see in terms of systematic investment or SIP inflows, these are numbers which are clearly sort of inching up month on month, and largely because more accounts are sort of getting opened up. So your SIP inflows are nearly about $3 billion or in excess of $3 billion on a monthly basis. So which is why it is becoming a good counterweight to the FI outflows. And as a result, what you see is a 12% kind of a correction in the markets. And while the individual stock level correction is a lot more higher, but Indian markets have been relatively a lot more calmer. And this is happening despite the fact that we are seeing record fundraising by listed entities in terms of QIPs. The primary market is seeing one of the record fundraising as well. And while these inflows are coming into the market, it's not coming as if this money is looking only at say lesser risky names. So while yes, the large cap inflows are there, but what we clearly see is a fairly stable flows to mid caps and small caps, which again also means that there is a fair amount of confidence in the broader economy to sort of do well, and that is clearly getting reflected in the FI in the domestic flows, which is becoming a good counterweight to the FI inflows. So I think structurally things are changing in India, and I would want to believe that if we are able to sustain this volatility, then possibly Indian investors or investors in general are taking Indian markets quite seriously from a wealth creation perspective. And I think it's one of the biggest structural positive changes, at least I have seen in the last 5 years.
Okay, quick point before we end. In future, do you expect any further changes in taxation? My sense is this question is for equities. So now we have short-term capital gains at 20%, long-term at 12.5%. Do you expect these rates to go up, or you would
So
want to kind of pass?
So, Nilesh, so on the taxation front, see, what is clearly coming out is that the government is looking at the simplification of the taxation. So that is the key focus of the government. Now, marginal relief to taxpayer looks sort of possible, but very difficult to say. At least they have not really done that. Now, the hike in long-term, short-term or STT is also sort of happened, and we wouldn't expect it to happen in the near future. But yes, when we see that the taxation structure is a bit higher in other geographies, so I will rule out a case where taxation could go up. But one thing is that overall simplification of the taxation is very much in the offing. Besides that, I really do not have any great inputs to sort of share. So from that perspective, yes, these are the only two key takeaways from the taxation perspective which I'm carrying.
Yeah. So let's hope that taxes remain the same and at best they go down. Okay. With that, we come to an end of this session, and basis what Samir and Pankaj have guided us, I one of the important takeaway for me is that for a global investor, Indian allocation has to be at least second best after US, if not the highest. Thank you for taking time out and request you to kind of share your feedback on the webinar as you wind down. Thanks, Pankaj. Thanks, Samir.
Thank you, Nilesh.
Thank you.